Hello and welcome to the session. This is Professor Farhat. In this session, we're going to prepare the cash flow statement for the print shop fund, which is a proprietary fund for the village of Perry. Now, remember, for the enterprise fund or for the proprietary fund, we use the direct method when we prepare the operating cash flow. Therefore, if you need any refreshment about the cash flow method, by all means, go to farhatlectures.com and go under our courses and go under intermediate accounting, and under intermediate accounting go to chapter 23, and there are 4 recordings that explain the cash flow in details. Now, you don't need, if you need to do so, by all means do so. Otherwise, I will go over a review. I will review the direct method as we're going through this session, but if you really need to kind of have in-depth review, please go to the original lectures. Now, we're going to go ahead and look at what we are giving. We are giving a statement of revenues, expenses, and changes in net position, aka income statement. Income statement. We are giving an income statement. This is what we know it by. And we are giving additional information about loans, different loans, which will deal with them each one separately. And we are giving changes in certain balances on the balance sheet, certain current assets and current liabilities. So the first section of the cash flow statement is to the operating section. And under the operating section, what we need to do, we need to convert each line on the income statement, convert it from accrual, because this is accrual accounting. Remember, we are using accrual accounting. We're going to convert it to cash basis. This is what the cash flow statement says. Give me everything based on the cash basis. We're going to start with revenue or charges for services. Now, how do we adjust revenues to cash basis? Well, we looked at the balance sheet and we want to see what happened to the receivable. What happened to the receivable on the balance sheet? If the receivable on the balance sheet went up, if we have more receivable, we will deduct this amount. If the receivable on the balance sheet went down, we add the amount of the decrease. So revenues is showing under the accrual basis as $1,150,000. Let's go to the balance sheet and see what happened to receivable. Accrued interest receivable, this has to do with interest. Due from other fund, this is a receivable. Receivable went from, this is the 2016 and this is the 2017. Receivable went up $15,000. It means we provided services to other funds and we did not get the money because our receivable went up. If the receivable went up, it means we have to deduct this amount. We have to deduct $15,000 from this amount. Therefore, cash flow from operating activities equal to $1,090,000. And what we just did, we just converted the charges for services to cash flow from operating activities. Why? Because receivable went up, we deduct the amount. If the receivable went down, we would have added the amount. Receivable went down means our customers and other funds paid us the cash, therefore we should add the cash to the revenue. Okay, so we're done with this. Salaries and benefit, the accrual amount is $495,000. So this is what we're saying, the accrual amount. Now, to really find out how much we paid, we have to look at the balance sheet and see if there's any account deals with services, sales, and benefits. And we see here we have a liability. Salaries and benefits went from $20,000 to $30,000. Now, this is a liability. And when a liability goes up, what does that mean? It means you are expensing something without paying. If the liability goes up. If the liability goes up, it means it went up exactly by $10,000. It went up. It means we are not paying the cash because the liability went up. Therefore, if we are recording $495 on the expenses, we can deduct $10,000 because there was an increase in the liability. So our cash paid to the salaries and benefit is only $485. Now, obviously, the opposite would have been true if the liability went down. If the liability went down, we would have deducted the amount because it means we are paying off liabilities in addition to the current expenses. Okay, but in this situation, the liabilities went up, which is minus to the expense, it means we paid less cash. It means we did not pay for it now. We're going to pay for it in the future. So we're done with the second line. Depreciation. Now, hopefully we all know what depreciation is. Depreciation is a non non-cash item, therefore we ignore it. It's a non-cash. We don't need to convert something that's non-cash to cash. Supplies used. What we're saying here is we used supplies of $200,000. This is the accrual figure. Now we need to see if there's any account on the balance sheet that's related to supplies. And notice here we have accounts payable for supplies only went from $30,000 to $25,000. So notice the liabilities here went down. And in contrast to the accrued salaries payable where the liabilities went up, here the liabilities went down. It means we paid an additional $5,000. So when the liabilities when the liabilities goes down, it means we have to add, in a sense, we paid more cash plus 5,000. So our cash paid, and by the way, those are negative. 485 is negative and 205 is negative because those are expenditure. Utilities based on the accrual figures, it shows 72,000. Now we need to see if there's any account related to the accrual. Related to the utilities on the balance sheet. So I have utilities payable. It's also a liability, and the liability here went up. Well, what does it mean? It went up by 1,000. When the liability goes up, it means I am expensing without paying. Expensing without paying. Why? Because my liability goes up. Well, if I'm expensing without paying, it means I have to reduce this by 1,000 because I did not pay for $1,000. Therefore, my total cash paid for utilities is only 71,000. Now, what I can do, I can net out. Those are my operating inflow and outflow of operating. $1,090,000 minus 485 minus 205 minus 71. I'll find out that this is 329,000 positive. So I have cash provided from operating activities, 329,000. Okay? Now this is the first section of the cash flow statement. Now why don't I include interest revenue, interest expenses? Those has to do with other sections. Remember, interest is a non-operating interest paid and interest received are non-operating under the governmental. If not, go back to the previous lecture in this course, and you will understand what I mean. I'm going to explain it shortly, but I just want to let you know why I did not touch those. Okay, so that's that. So that's the operating section. The next section, so basically we dealt with this payable is gone, utilities payable is gone, accrued payable is gone, supplies there was no change, due from other fund is done. Okay, so all these accounts are used up. Now the other section we're gonna work with is cash flow from non-capital financing activities. Non-capital. So we're gonna look at non-capital financing activities. So basically we borrowed money or we paid off money, but it has nothing to do with our capital activities. So let's see what these are. Okay. Contribution from the general fund for working capital need, $80,000. For working capital needs, $80,000. What does that mean? This is a contribution from the general fund. So basically the general fund gave us $80,000 for our money need. It doesn't say capital asset. It has nothing to do with, we did not buy anything with that money. We did not buy any specific asset with that money for capital needs. Just we needed money. Therefore, this will be, let me see. Maybe I should screen print this, and I'm trying to capture the screen. Give me one moment, please. It's not capturing. That's fine. We can ignore this. So basically, I'm looking for non-capital financing. So this is non-capital financing activity, and that's a positive $80,000. Contribution from the general fund for the purchase of equipment. Notice here, it's the same thing, except that they said this is for the purchase of equipment. Hold on a second. This is a financing activities that's capital related. So capital and related financing activities. So this is capital, I'm going to abbreviate CF, and that's A plus because they gave us the money. So notice one is non-capital and one is capital financing activity. Loan, which is interest-free, from the water utility fund to purchase equipment. So they gave us the money for the purpose of purchasing equipment. Guess what? We'll get the money, and it's a financing. It's CF, capital financing, capital and related financing activity. Obviously, purchase of equipment. Hopefully you get this right. This is a minus, obviously, and this is a capital finance. Okay. Purchase of equipment. Purchase of 1 year investment. Here we are dealing with an investment. That's minus, obviously, and that has to do with our investment. Paid off a bank loan outstanding as of May 1st. Now we need to know what type of a loan was it. What type of a loan was it? That's important. Why that's important? Because it's going to tell us if this is a non-capital financing activity or a capital financing activity. The loan was short-term, operating purposes, was only interest-bearing. Well, it was for operating purposes. It has nothing to do with our capital. Therefore, it's a non-capital financing activity. All right. Signed a capital lease. We just signed a lease. It has nothing to do with anything. Therefore, we can ignore this. All right. So now what we can say is, let's see, if we have 51,000 for non-capital financing. We have 8,000 for non-capital financing. And here it says the loan was the only interest-bearing debt. So we have some sort of an interest here. So let's go back to our interest. So the interest expense here was 5,000. So notice, so this 5,000 here is a non-capital financing, but we have to be careful. Anything that's on the income statement, we have to see if there's any related balance sheet account. Let's see if there's any interest payable. And notice here we have accrued interest payable. So notice, let me highlight this. We have accrued interest payable. We went from 1,000 to 0. It means we paid off the liability. Well, guess what? Although we are recording 5,000 on the income statement, since we paid off the liability, it means we paid an additional 1,000. So we paid off $6,000 because we recorded 1,000. Then since the liability went down, we're going to add an additional 1,000. So we paid $6,000 in interest. Okay, although we recorded 5,000 on the income statement, because the other 1,000 was to do what? Was to pay off this $1,000. Therefore, we're going to have net minus $6,000 non-capital financing activity. And I believe those are all the non-capital financing activities. So if you take 80,000 plus, so 80,000 plus, we're done with that, minus 51,000, we're done with this, minus 6,000, minus 6,000, so this is 57 minus 7, so we have plus 23,000, that's non-capital non-capital financing activities, cash flow from non-capital financing activities. So this is the second section of the cash flow statement. The third section is now capital and related financing. We have the 100,000, we have the 300,000, and we have the 500,000. So those three, let me highlight them in yellow. Those three, oops, let's do yellow so we can see the numbers. Let me erase first. So the 500,000, 300,000, and the 100,000. So if we net those out, capital financing activities, those three, if we net them out, plus 400, that's minus 100,000, and that's for capital financing. So this is a major number, and this is a major number. Those are categories. Okay. So, and notice what happened to the bank loan payable. 51,000 went down to 0. That was accounted for right here. Now paid off bank loan. So notice this is also accounted for. The only thing that hasn't been accounted for is accrued interest receivable, which is part of the investment. So let's take a look at the investments. Under investments, we said we had 50,000. So under investments, we had we made an investment, so we purchased an investment. It cost us $50,000. Then on the income statement, we have interest revenue of 3,000. So that's interest revenue of 3,000. Once again, anything on the income statement, we have to see if there's any related balance sheet account. If we look at the balance sheet and we see our interest receivable went from 300 to 500. So our receivable went up. This followed the same concept that I told you about revenues. If receivable goes up, it means 200, it went up 200. It means we did not receive cash of 200, although it was revenue, but we did not receive it in cash. Therefore, the only cash we received is 2,800. Now, again, the opposite would have been true if receivable went down, but receivable went up. Okay, so our interest revenue on a cash basis is only 2,800. So plus 2,800, and I believe that's the only thing that's investing. So 50,000 minus plus 2,800, that's plus 47,200. That's the fourth category. So basically, our cash flow from investing is positive 329. Non-capital financing is plus 23. Capital financing is negative 100,000. And investing is 472,000. Now what we do is we'll net them out, take the change, we'll net them out. Unfortunately, I'm not being able to capture my screen, but you net them out and you add them to, let me just net them out. Let me just net them out here. 329 plus 23,000 non-capital minus 100,000 capital financing minus 47,200 for investing. So the change is an increase of 204,800. I'm going to take 204,800 and add it to the beginning cash. The beginning cash was 151,008,553. 355,800. Hopefully my ending cash is 355,800, and my ending cash is indeed 355,800. I know my cash flow worked, and this is the best thing. That's the best feeling you would have when you get this in the real world, that your cash flow worked. Now, the other thing that you have to do for governmental is you have to prepare the reconciliation, which is using the cash flow using the indirect method. Actually, we can do this also real quick. Just if you don't remember the indirect method, it's helpful if you go ahead and do the review. But let me go ahead and do the indirect method real quick. So under the indirect method, basically it's a reconciliation. So you start from income from operation. So you start with this number and you work backward. So income from operation is 38,000. Then what you do is you add any non-cash expenses, and we said depreciation is a non-cash expense. So basically what we're going from operating income to cash flow from operation. That's what we're doing. So the first thing is we add any non-cash expenses such as depreciation. Any asset that increased, any current asset, to be more specific, any current asset, because we're dealing with current asset, any current asset that increased, we're going to deduct. Anytime a current asset decrease, we're going to add. Any current liability that increase, we're going to add. Any current liability that decrease, we're going to subtract. Okay, we'll explain why in a moment. Now let's take a look at our current assets and current liabilities for this example that deals with operating activities. Going back here, we said due from other funds. You remember we had this account due from other funds. It went up. It went up 15,000. If it went up, it means if receivable went up, it means we are not collecting cash. Therefore, it's a negative. So this is, So this is negative 15,000. Supplies did not change. Accrued salaries and benefit payable. A liability went up 10,000. That's a plus. When your liabilities go up, it means you are not using your cash to operate. Utilities bill payable went from 4,000 to 5,000. It went up. That's also an increase of 1,000. It's a plus 1,000 because it's a liability. Accounts payable went down 5,000. If it went down, That's a minus. I'm paying off my liabilities. That's minus 5,000. Accrued interest payable. Accrued interest payable. Remember, accrued interest payable. That's went from 1,000 to a 0. We don't include this. Remember, interest has nothing to do with operating. So I just remember I'm dealing with government, not. I'm dealing with government. So that's it. That's it. So negative 15 plus 10 plus 1 minus 5. So let's go back. Negative 15 plus 10 plus 1 minus 5. Let me go back here. Negative 15 for the receivable. This is for the increase in the receivable because receivable went up. We have plus 10,000 because the payable went up. The accounts payable went up. We have minus 5,000. Minus 5,000 because the payable went, the liability went down. The AP went down. And we have plus 1,000. Plus 1,000 because the liability went up for the utilities. For the utilities payable. Now let's see, 38,000 plus 300 minus 15,000 for the receivable plus 10,000 minus 5 plus 1,000. That's equal to, let's see, equal to how much? Equal to 329. Excellent. So now let's see if I got 329. And yes, we did get 329 when we did the direct method. So you do this indirect method just to make sure your numbers, you did it correctly. So, and I did cancel the answers, but I know for a fact that the number was 329 for the operating. So this is basically the indirect method. So you still have to do the indirect method as just kind of checking your work. Hopefully this exercise will help you prepare a cash flow statement. A cash flow statement use for the governmental enterprise fund. If you have any questions, any comments, by all means email me or see me in class. And this is definitely will be covered on the CPA exam.